Jerry, when you're ready to go.
You're good.
Okay, welcome everybody. This is the time and place for the technical conference in docket number 1703569, discussing the revenue requirement impacts of the new federal tax law. My name is Jamie Dalton. I'm with the staff of the Public Service Commission. We welcome you here today and those on the phone. So let's go ahead and go around the room with introductions. And Vicki, if you'd like to start. And by the way, we've got a sign-in sheet. If you would all please sign this, we'll make sure that gets on the record as well too.
Vicki Baldwin for UIEC.
Cheryl Murray with the Office of Consumer Services.
Carol Revelt, Public Service Commission.
Jacob McDermott, Rocky Mountain Power.
Steve McDougall, Rocky Mountain Power.
Joelle Stewart, Rocky Mountain Power. Nikki Cablillo, Rocky Mountain Power.
Trish.
Tricia Schmid, AG's office for the division.
Hi, my name is Ryan Fuller. I'm with Rocky Mountain Power.
Sherry Vance Commission.
Lori, you want to introduce yourself?
Laurie Harrisburg, Public Service Commission.
Dave Clark with the Commission. Joseph Holland with the Commission.
Melanie Wright with the Commission.
Artie Powell with the Division of Public Utilities.
Jeff Einfeld with the Division of Public Utilities.
Gary Smith, Division of Public Utilities.
Justin Jenner with the Utah AGs representing the division.
Lane Meekum with the division.
Kevin Higgins for UAE.
Neil Townsend for UAE.
Courtney Higgins for UAE.
Justin Bieber for UAE.
Okay, and those who come in the room.
Nick Highsmith, Rocky Mountain Power.
Janice Sauer, Rocky Mountain Power.
Got everybody in the room? Looks so. On the phone, please.
Donna Ramus on behalf of the office.
Okay.
This is Morris Brubaker on behalf of UIEC.
Welcome.
Chris on behalf of UIEC.
Could you repeat that, please?
Sure. Chris Walters on behalf of UIEC.
Thanks, Chris. Anybody else? Okay. Well, it looks like we've got the slides here, so we'll turn the time over to Rocky Mountain Power. And if you would, since we've got folks on the phone, when you go to the slide, if you could let folks know what slide we're on, we would appreciate that. So we'll turn the time over to you.
Okay, so does everybody have a copy of the slide?
Pardon me, I'm going to make some more copies. Am I the only one who needs a copy? Or are there more?
I could actually use one.
I could too.
Okay. I was going to say, just that short, just one.
I sacrificed mine for the good of the group.
You can't have mine, it's fine.
Okay. I'd like to welcome everybody here, and just to formally let you know, so I'm Steve McDougall. I was one of the two witnesses, and as was Nikki. Also, if we get into any of the technical type tax questions, Ryan Fuller is our director of tax. So those, as you get into the questions, just to let you know who will probably be answering most of them. So if we start with the slide deck, the first slide just goes through an overview of the Tax Reform Act. And the company had identified in our testimony and in all of the other dockets 6 notable items that have changed. First was the big change that everybody is aware of, the 35 to 21% federal income tax rate. So we always put that within our models, and that's the biggest impact. There's a requirement to normalize the excess deferred income taxes. We have restated the deferred income taxes with the public utility property has to be amortized using the ARAM method, just the average rate adjustment mechanism.
Is that just for the protected portion or?
Yes.
Okay.
We have the elimination of the allowance for bonus depreciation for public utility property. The repeal of the domestic production activities deduction, also called Section 199. the repeal of the exclusion from income for the contributions in aid of construction received from governments, and the repeal of the deduction for certain limitations with respect to expenses similar to business meals, parking, and there's a few things where they've just eliminated the deductions. So those were the changes that we were trying to isolate. So to calculate the impact, what we have done is we started with the results of operations. So on this is on the next slide. So we took the results of operations for calendar year 2017. And that became the before the Tax Reform Act. We're gonna call that the 35% tax rate model because it was utilizing the old tax rate. And then we made certain adjustments that we're gonna describe in the next slide to that, to get a pro forma 2018 perspective. And that was done because part of the change was the change in bonus tax depreciation. And we had to get a period where we could look at what that impact was, so we took that forward to 2018. And then we came up with what we called the after-tax model, and that's the one that we compared it to see what the impact of the tax rate change was. So by comparing the two runs, that became our differential that we've reported. So if we go to the next slide, and if at any time you have questions, please let us know. We have the questions at the end that we'll go over that have already been asked. So like I said, we started with the results of operations as filed. To those operations, we added 4 plant adjustments called 9.1, 2, 3, and 4. What they were doing was adding in 2018 plant additions. We did that because, as I said earlier, the bonus depreciation, in order to get a look with and without bonus depreciation, we had to select a period and say, what is that period? And we elected to look at 2018. Because of 2017 actually does have bonus depreciation, so we didn't want to mess with actuals where we will have the bonus depreciation, and it creates some issues with the tax laws and the normalization. So we elected to take plant forward to 2018. As we took the plant forward to 2018, the plant was walked forward in 2 separate adjustments, 9.1 and 9.3. 9.1 does the major plant additions over $2 million. 9.3 does all the remainder. There's only one reason we really broke out those 2 categories, and it really does not impact Utah. But the reason we broke out the adjustment was for our ease of calculation, because in states other than Utah, when we do the results of operations, we already included the pro forma adjustments for major plant additions, those greater than $2 million. So we already had that adjustment prepared, and it was already filed in the other states. So we added onto it the second set, the under 2 million or 9.3 in the other states. And just to make sure that all the numbers are consistent, we did those exact same 2 adjustments in Utah, which are just the 9.1 and 9.3. So there's no reason other than our ease of calculations that it was broken into 2.
So Steve, you would see in the results of operation and in the jurisdictional summaries, you'd see different amounts for all states then with this model?
No, not in the model we're actually using. There are some differences based upon individual state views. And so, for instance, when we're into other states, they allow pro forma adjustments for other items. And so we will have some differences in other states, where in Utah, we generally don't do any pro forma. That's you're the only state that we don't do those pro forma adjustments. So other states will have other changes, and they all have different rules from prior proceedings. For instance, our depreciation expense on the Klamath decommissioning cost was different in all states. and there's individual regulatory assets and items that are different in states and are depreciated over different time periods. So the starting point, you know, for the results, the June actuals, I mean, the December actuals are the same, but then there's always state-specific adjustments.
Next question.
Yes.
It seemed like the plant addition information that we received was in summary format. It didn't have the 13-month average calculation that usually is in a rate case or the descriptions of the additions that are normally provided in a rate case. I was just wondering if there's other work papers that were used to generate those kind of lead sheet adjustment files.
There isn't. The sheets we gave you are the sheets we used to calculate. In a rate case, we actually go back to each of the departments and ask them to develop each of those descriptions. And so those descriptions are not something that just we normally do for the results of operations. But, you know, there are projects behind it, but it is not something that we have pulled together. Okay? And on all the projects, the amount of the capital we're adding is not what we're trying to get to, and it was added identically in both the 35% model and in the 21% model. So the only reason for adding the capital is not to, because there's a recovery of it anywhere. There's no dollar recovery for the capital. It was put into both models just so we can measure the difference that we have, you know, that bonus depreciation would reflect on those capital additions. So it was just to calculate that one portion of the tax law, because we look at what we're actually going to be paying to the IRS before and after. That's one of the differences. So I just want to make clear that's also part of the reason why we didn't go through all that additional effort and the time that is required.
Steve, can you kind of explain how that bonus depreciation flows between the two models? What the difference is?
Well, what the difference is when you have planned additions. So under the old tax law, if you had a $100 million planned addition, bonus depreciation under the tax laws, if you get a 50% bonus depreciation, what you get to do is, for tax purposes, take the 50% tax deduction plus your normal tax amount.
So in the 35 model, what you're doing is you're taking that bonus depreciation, which means you're pushing that tax payment off into the future at some point. Okay.
And the way the tax difference flows through the model is really only in the ADIT area. So you take the difference between book depreciation and tax depreciation times by the tax rate, and that is, you know, and we hang that up as your deferred income taxes. So when you look at the old versus new tax law, because of the change in bonus depreciation, it's going to impact your ADIT balance. And so that's what we're trying to get there, is that difference in the ADIT balance because of bonus depreciation.
Accumulated deferred income tax. I had to think for a minute there.
Yes, excuse me, sorry. Accumulated deferred income tax is the ADIT.
So
if I use any other terms, just.
So an immediate tax liability, what you're gonna pay to the IRS under the 35 model versus the 21 model. What's the impact? Increase or decrease based just on bonus depreciation?
It's an increase.
Yeah.
Okay, that's what I would think.
Right.
Yeah.
And
Yeah,
so,
we no longer get that deduction for
Right,
utility
right,
company,
right.
correct? So our cash is going.
Yeah, so you get
cash
a lower
out.
deduction, so you have to pay more taxes.
Yep.
So it's an offset to the change between 35 and 21.
Right. And so when you change the tax rate in the model, you're automatically changing the current taxes. So that deferred portion that then goes onto the balance sheet as your accumulated deferred income taxes changes by that amount. And so it's the return on that that is going to impact your revenue requirement.
Right, and just to follow up on that too, where customers never got the direct benefit of the bonus depreciation,
Right.
but indirect, right? And that's where
Indirect, they get the time value of money
right
for that, through a rate-based deduction.
Right.
Right.
And Steve, just to go back half step, so just to be clear, with this exercise that you're going through with the major plan additions and the other plan additions, does not involve actually seeking recovery of the incremental capital cost, but rather you're using them as part of an exercise to kind of ferret out the impact of the change in bonus tax depreciation. Is that
Right.
fair?
Yes.
Okay, thank you.
And so that's what we're trying to do. And so when we then take the 35% model and we look at the after-tax model, which is the 21%, which the discussion starts on the next slide, what we then did is take those exact same plant additions, and that same adjustment is in there. If you look at the adjustments on the next page where we talk about it, we updated the adjustments, not for any change in plant, but only for the change in bonus depreciation, which will impact your ADIP balance. And the ultimate goal when we did the two models was to look at the exact same ROE. So we said, we don't, any under earnings that was existing before because we were earning, a certain ROE, we didn't try to say, oh, let's take it up to an authorized, let's get extra. We tried to keep, we did keep the ROE at the exact same level. So it's more of a price change type of approach, just to keep the ROE equal, so it's just the revenue requirement differential between the two tax runs. Not trying to, like you're pointing out, we didn't try to get recovery of the planned additions and say, oh, look, this model compared to results dropped it down, let's get back up to where the results were.
Okay,
It's just trying to look at the difference for bonus depreciation.
Steve, just a quick question. Are there any grandfathering type rules for any of the assets, or is it just going forward, no bonus depreciation? Are there any rules for, because it seemed like when they passed the Tax Reform Act, if I remember right, there were some rules that said if you were doing this at the time of the Tax Reform Act, you would still be able to qualify for some of these types of rules. Is there any type of rules that affect bonus depreciation that way, or?
Yeah, there's a transition rule.
There's a
The general
transition
cutoff date was September 27th, and then, for assets that were under construction prior to that date, and then subsequently placed in service, there are rules that qualify a portion of those assets for bonus depreciation.
Okay.
So under our 35 versus 21, we took anything into account. I'm not even sure if we had any that was still.
I'd have to go back.
I'd have to go back and check. But
Okay, so there could be potentially some
yeah,
assets
it would
that
be-
fall in
but
that category.
the deadline was
Right,
you said,
yes, I recognize that there
Yeah.
could be very little or
Yeah.
none. I just was curious, so.
Yeah.
Steve,
Uh,
before we leave this slide, I
wanna-
do have a couple of questions. I think that's Donna. Go ahead, Donna.
Oh, I'm sorry. Yeah, I just had one quick question before we leave this area too. Is that adjustment 9.1 also, my understanding is it annualized the 2017 plan additions as well? And I guess my question is the reason that was done because that's how the adjustment's done in other jurisdictions, or was there another reason for annualizing the 2017 plan additions?
It was done more to look at a pro forma 2018 plant, so we took where we thought the plant was going to be during the months of 2018, but they're really for annualizing. There was not, and it should not impact things, no. But
So
it
it
was
shouldn't
done
impact-
just to try and get a correct view of 2018, if you will.
Okay, so by annualizing it, then it shouldn't affect that $65 million number associated with the current taxes.
No, because we're adding that plant identically under both.
Okay, yeah, that makes it a bit clearer for me. Thank you, Steve.
Okay.
The plant additions, under a hypothetical, let's suppose that part of those plant additions are disallowed in the future when you do seek cost recovery. Does that have any impact on the benefits of the tax calculations now? In other words, will a company come back and say, hey, we gave you that benefit, but we're not getting cost recovery, so we need to take that tax benefit back? Is that an issue?
I'll be honest, I have not thought of that issue. So.
Can I vote?
Yeah, I would think that would be an issue.
I would think that.
Try not to have a Helsinki moment.
It would be an issue.
As I think of
Yeah.
2018, I don't think there's anything particularly unusual about the additions, but not to say, something could come up. They're fairly run rate routine in the numbers.
Right.
It's not till, later years
Right.
that
We
we'll
didn't
have other
have anything like
repowering.
Or a new asset
Glad you said
that we
it.
put in that was controversial.
They're all
But
fairly
if there
standard.
was, I'm sure that's an issue that would have to be addressed in a future rate case. That I don't think any party would want to negotiate away right now.
Right. And I'm assuming the depreciation rates and these adjustments for the plant additions, those are the current depreciation, and not trying to
Right.
guess what your new study is going to say.
Right.
Okay.
Because one, we were looking at 2018, and we know anything
And those
happen.
will be beyond.
Yeah, those will be, out a few years. So.
Right. Okay.
Okay. Let's see if there's anything else on that first tax rate model. So if we go to the updates of the revised results of operations continued, we also added in 3 new adjustments, and we corrected, and there was some flow-through impacts on 2 others. The three.
What slide are you on?
It's one that says updates to revised results of operations.
Number 6.
Page 6 on our
Yeah.
slide.
On slide
There's numbers on there.
Okay. We've already went through this slide. We're on slide 6.
He didn't tell us we moved to a different
sorry.
slide, so we were all fired.
They all start updates, okay.
This morning, one of our big problems was we couldn't get the page numbers to work. And I hadn't looked at that to realize that they.
That's pretty funny.
Okay, sorry.
For reference,
Of course.
they're good now?
Yeah.
I was off.
And so I wasn't referring to the numbers because I was thinking we couldn't get those to
Where
work
aren't
there.
Well, your job just got easier.
Yes. Yeah. So slide 6 now. That does make it easier to say that rather than
For the record, I manually added 14 page numbers.
What's the challenge?
He's trying to
We
improve
appreciate it.
He's trying to improve his review.
It is that time of year, huh?
I got a few
Okay.
ones.
Almost.
Okay. So the adjustments we added were 9.5. 9.5 adds into the results the ARAM amortization. So it includes into the results all of the accumulated deferred income taxes, and if we flow that through the ARAM amortization that we have included in the tables, which are, we have taken the property related.
It was howling.
Yeah, sorry.
It's someone who came in behind another group of people.
Okay.
Social Security.
Okay, I wasn't, see, I was concentrating on what I was saying, I didn't notice.
We weren't laughing at you.
Okay, I was thinking, okay, what did I say that was wrong here?
ARAM.
Yeah. You know, the only problem I have with the title ARAM is I had a bet, because Nick's wife just had a baby, and everybody put a pull in on what she was gonna name, they were gonna name the baby, and I bet on ARAM, and they did not.
That's a good one.
I mean, I thought that was a perfect, you know, name, that you could always tie back to something.
Yeah. Maybe he wants to forget this.
As you can imagine, my in-laws, who are not accountants, didn't really find that funny.
Okay, so 9.5 has the ARAM amortization. We've identified that amount in the table if you look at the adjustments.
So when you calculate this adjustment, I'm just trying to think of the, how you do this, and for each piece of equipment, you have an old, schedule and then a new schedule, you have to add everything up, or how does that work?
It really is for each of the pieces of equipment. When you restate it, you have your accumulated deferred income tax balance. And Ryan is
Yeah,
gonna
I'll
correct
just-
anything
Yeah, you
I
might
say.
as well
I'm just gonna say
Yeah,
And would be helpful to use that table we had in.
Right, that's what I was,
Yeah, I mean, it's, the way that we got to ARAM is a with and without calculation, where if we can run 1 year at 35%, and we can run another year at 21%.
So it's all just in a.
In our tax system.
Oh, okay, it's in the,
Yeah.
so, but for each piece of equipment, you've got this, and then it just does all of the,
Yeah,
machinations and comes
for all
up.
the records that we have in our tax, yeah. So it was a with and without calculation to get to the.
okay, so that's the ARAM. Adjustment 9.6 restates your deferred income tax expense. And so what it does is correct, you know, the deferred income tax amounts that are within the results to correctly state them using the 21 versus the 35%. Adjustment 9.7 that we added is our tax deductible items. So that takes your section 199, domestic production activities deduction, the meals and entertainment, transit passes, and changes the deductibility of those to reflect what the new law will, you know, the changes are. So it just reflects those changes and brings those changes into our results.
So, excuse me, this is Carol, the section 199 is part of the repeal of the deductions? And
Yes, yes, it was one of the deductions that was repealed. And so they changed the deduction of those 3 items. And then the last 2 adjustments that happened were adjustments 7.1 and 8.1. Those actually flow through the model automatically. Those are the adjustments for the interest synchronization and cash flow from capital. So as you change the other adjustments, by default, it impacts those 2 adjustments just to get them back in sync. So those are just 2 that's why we combined the 2. Those are 2 that just flow through automatically that are updates within the model.
On your first page here, do those updates include the repeal of the domestic production activities deduction? Where's that? Is
That's
that
the section 199.
That's the section 199.
Okay.
Yeah.
And so where we went, said on there, you know, on 9.7, the section 199, that is the domestic production activities deduction.
And does that include the next one, the contributions in native construction as well, this adjustment?
I'm not sure if there were any changes on the kayak that impacted us in the results. I don't believe.
Go back.
Yeah, I'd have to go
I'd
back.
have to go back and look.
I don't think
If
it's
so,
had
it was in there, but I don't believe it actually impacted our results.
But that would have fallen to the deferred income tax category because it's a temporary book tax difference, and some of the things you have listed here in 9.7 or
So
more.
if there was, it would be captured in either the 9.6 or 9.7. Have to go back to the work papers to see if there was any impact of it.
Can I ask a question? Is it Nick?
Ryan.
Ryan, I'm sorry, Ryan.
No problem.
One of the things that, this is trying to get some intuition out of the ARAM calculation, okay, which is hazardous, I realize. But one of the things we're seeing around the country a little bit is that when you take the excess ADA and sort of just do a simple math, maybe divide it by an amortization period, say 20 years, 25 years, we don't really see in the upfront years, the early years, kind of an even amortization number. Sometimes it's a little bit lower than one would expect. And my question to you is that something that you see as well? And if so, does it have something to do with the way ARAM sort of allows an amortization to start to be triggered in terms of the kind of the inner math of it? Does that question make any sense?
Yeah, I think ARAM, the actual amortization of the excess deferred income taxes on ARAM is calculated at a vintage level, and it doesn't actually start showing up until book depreciation exceeds tax depreciation.
Right, so you got a crossover point before it can even kick in, right?
And all those asset levels that we have in the system.
So in that way, it could be unpredictable in terms of when, how the amortization will come through. It depends on when the vintages start turning, where the book depreciation exceeds tax depreciation. Other elements that can make it unpredictable would be retirements and things of that nature.
Thanks.
Can I ask a question here, kind of along that line? My understanding from one of the data responses I had is that the early retirement of the wind repowering assets is going to trigger a higher ARAM amount in the periods those are actually retired. I guess, could you explain a little bit, maybe Ryan, on why there's a spike caused by the early retirement of those assets?
Well, to the extent that there's excess deferred income taxes and they're retired, then the whole balance would effectively be realized at that point in time, rather than an amortization over, let's say, the entire book life of an asset that's not retired.
Oh, okay, so then in the future, any early retirement of assets, say if they're coal assets or those repowering wind assets, if they're retired early, then you would get a spike in that year of the amount realized in the ARAM calculation, correct?
That's right.
Okay, thank you.
Okay, and something similar would happen even without the tax law change. It would have just been in the deferred income tax area instead of in the ARAM area. So.
Yeah, it'll hit both areas then, right?
Yes.
Then
Yes.
the normal continuing and the excess deferred.
Right, just like it would on a normal, even without the tax law change, when you do retirements, it impacts the balance. Okay, any other questions on slide 6?
Yeah, this is Chris Walters. I want to have a little quick discussion, I guess, if you would, on adjustment 9.5. You guys state, and I'm pretty sure, so the property-related non-protected excess ADIT, you're proposing to amortize it over ARAM, though it's not required to be. Can we have a little description or discussion of what qualifies as property-related non-protected, just so I can have a clear understanding of what's included in that?
Property-related non-protected. So generally what's protected by the Internal Revenue Code is method and life differences on depreciation, and what is not protected are basis differences. And so, an example of something that's property related, but not protected under the Internal Revenue Code, for example, would be the repairs deduction. So that's where we have an accelerated deduction for tax under the repairs rules, and that wouldn't be protected. So those are reflected within the power tax system, where they were deducted for tax purposes but are being depreciated for book purposes. So those are all within our power tax system. So I mean, that's the general rule. Kayak has generally been protected as well. That's another item, but it's generally method of life differences in kayak that are falling under protected, and all other basis differences are non-protected.
And then we gave you the
So
balance. Wait, go ahead.
I'm sorry, when you get into the, like say, repairs of the property, so that's maintaining or extending the lives of the assets that are being repaired, but the repair themselves are not necessarily a 30 or 35-year life?
There's just a special rule for taxes where it allows us to take an immediate deduction for the repair. That's it. So it's not depreciated. It's just deducted.
Yeah, under the accounting rules, it still qualifies as an asset that you amortize over its applicable life, but there's a separate discrete deduction that can be done for tax purposes.
Yep.
And then, is it, I guess in my understanding, that your tax software, it basically will not allow you to do it under any other method or any other amortization period?
The tax software as it's presently set up, reverses all the excess deferred income taxes over ARAM, but it can be modified to do something different. It's just not presently modeled or set up that way.
Now, there was, some of the questions we were asked to answer were on that subject. Should we just discuss those now?
Sure, I think it was an OCS question.
So as long as we're discussing it, it might, or would it be easier just to wait till we get there? Why don't we just?
I'm happy to discuss it any time. I mean, the question, let's just talk about it now. The question was just whether or not it can be separated, I guess, within the power tax system and amortized over a different time period, not utilizing ARAM.
And what page are you on?
Is that page 11?
Yes, I think so.
Questions, yeah.
Yes.
Which question is it? One or two?
The second question. Yep.
So it's OCS questions, second question down on page 11.
Yeah. So, I mean, I think that was just the fundamental nature of the question, was whether or not the non-protected portion of the excess deferred income taxes could be isolated within the power tax system and amortized over a period. That's different, not using the average rate assumption method, and the answer to that is yes. And the cost estimate we've gotten from power tax is about $40,000. I think we responded to that in a data request response previously, which was OCS 3.3. And so, it would take months, not months, I think, it would take 6 weeks to do the modification. That would include kind of our internal processes where we're required to take the system out of production into a test environment, make sure that from an internal control environment standpoint that none of the records have changed, and then bring it back online into the production environment again. So, and if we did it piecemeal, if in other words, if every jurisdiction had a different outcome, then the cost would just go up from there.
Okay. We go on to slide 7. The additional considerations, one, the accumulated deferred income taxes. When it was restated originally at the end of 2017, there really is no change to accumulated deferred income tax or to the rate base, because all you're really doing is moving accumulated deferred income taxes into the excess deferred income taxes. And it's just moving from the ADIP balance to a reg liability, so there really is no immediate rate base. There is a change over time as because of bonus depreciation and because of the amortization of the ARAM, but the immediate impact is very minimal. So we verified that. The other impact that we have that's unique in Utah is the FERC OAT rate. Because one of the other items that will be changing is our FERC OAT rate. It's under a formula rate, and the tax law change will change our FERC OAT rate and will change wheeling revenues. So in states other than Utah, we have put in an adjustment for that. In Utah, there was no reason to put in an adjustment, and if we did, we would have double counted, because part of the EBA is a true-up of wheeling revenues. So any impact this has on wheeling revenues will automatically be picked up in the EBA as a difference between the wheeling revenues and what they would have been versus what they are. So we didn't want to make any kind of an issue where we would double count it and offset the give back in the rate case while it's tax proceeding, then offset it again in the EBA. It would have caused us to under give back what we should have. And that's why we pointed that out in testimony, that we had the FERC OAT rate issue, but it is not, in Utah will get picked up by default in the EBA.
For the excess added, I know that FERC hasn't made a decision yet. Well, that will also fall in through the wheeling revenues?
Yes,
Okay.
because any impact on the FERC OAT rate will impact our wheeling revenues. And it could impact it in different years because of the true up, but it will impact it. And so that, if you look at the wheeling revenues we're going to collect, they will be impacted. Now, in the EBA, it's gonna count a whole variety of changes. It will count all the changes in load and all the other changes, and it will just be net in there. So there won't be a line that says taxes, but it is reflected in our FERC OAT rate. So any of that impact will automatically flow through.
What is the timing of the change in the formula rate versus your filing for 2018, which will be in March of 2019? And what portion of the year will be reflected in that 2019 filing?
I am
The
not
2019 filing
sure.
For the
EBA.
For the EBA.
For the EBA,
Well, so-
well, the EBA would catch any of the changes in wheeling revenues as booked for calendar year 18.
Well, when does the OAT rate change relative to the
So-
calendar year 2018?
So we've already filed our update to the OAT rate, which runs from June 1st through May 31st. So our filing that parties are now, we're in a proceeding related to that, has reflected the change in the tax rate from the 35% to the 21%. The piece that's not yet in the filing is how to amortize the ARAM, because there was no method under the formula rate to do that, and there's a notice of inquiry right now. So I think that piece is gonna still take some more time, but at least the core 35 to 21 is reflected starting that June 1st date, and then it'll get trued up next year if we have a true up associated with anything else in the formula rate, plus maybe the ARAM will get picked up. We don't know, there's still some, lots of open issues associated with it.
So if it runs from June to May, then does that mean that when you file the EBA in 2019, it's really only picking up a half a year?
Yeah, from the June to December time period.
But then the next filing will pick up a full year.
And a true up.
And the true up for the prior year, if there's any
Okay, for
18
the
true up.
6 months.
Yes.
That wasn't captured in the 2019 filing. That would be a true up in the next year's filing.
Yeah, because we
Is that
have,
what you're saying? Okay.
we do an update and then a true up as a look back for the prior year. So at that point, it would capture a true up component for this June 1st through May 31st of 19.
Okay.
Okay.
One more question, sir. On the retail side, have you made adjustments to the accumulated deferred income tax balance or the deferred liability associated with the excess for the ARAM amortization itself. So sort of a rate base adjustment to capture the ARAM.
For the transmission related, yes.
No,
Not on
she
the
said
trans, on the retail side.
So in other words, like, I mean, I think what the ask is, if you had $10 million of excess deferred income taxes amortized, was there then a reflection of $10 million impacting rate base?
Yes.
And so basically that would be in that adjustment, and I think the answer is yes,
Yes.
it hits both the rate base and the expense components of the.
Thanks.
Okay. So the next slide, slide 8, shows the total impacts that we're getting right now that we have included within our filing. So when we looked at the two models, the 35% and the 21% tax rate models, using the price change type approach, trying to keep the ROEs and the two models identical, what we found was the current impact is around $66 million, $65,890. The wheeling revenue offset that is not included because that will come in through the EVA. And then the ARAM amortization, the revenue requirement impact of that is around $26,413,000 for the total of $92,303,000.
Did you estimate, or have you estimated what that wheeling revenue impact is?
Yes, we included the number in my testimony.
It was about $3.5 million on Utah's share, for Utah's share.
And that's a reduction in a sense to this 92, right?
Yes. But like I said, if I would have put it in here,
You would have double counted.
I would
Yeah,
have double
understand
counted,
that.
and I could, you know, what we're, the whole goal we were trying to get to is we want to give back 100%, but we don't want to give back 90%, we don't want to give back 110. We're trying to get to the 100% level.
To protect those ratepayers.
Huh?
Can you explain that 3 million estimate a little bit? Because the OAT rates are almost the same as they were last year, so there's a reduction in the rate because of the tax changes, but then there's an increase because of other factors. So how does, where do you come up with that 3 million?
What we
just isolated to the tax changes?
Yes. And so the EVA will include both parts, the increase related to the rate base and related to the other items, and the reduction related to taxes.
So they'll net out?
So they'll net out somewhat. I have not looked at the final numbers, but my understanding is there's both directions. Where in other states, we were trying to just isolate with and without tax rate. So that's where the estimate came from, was our numbers, our estimates from them, from our transmission division that calculates the OAT rate, just saying what is it with and without.
Another question, do you have any sense, we're just talking about the adjustments, including the 2018 plant to reflect kind of the bonus depreciation impact, if you hadn't done that, if this number, this 92 million would be higher or lower?
It would have been higher, and there was a data request by the OCS. I think it was around $2.5 million.
Yeah, so OCS set 6, question 1, asked basically that same thing, and I want to say the impact was like $2.7 or $2.8 million.
Yes, if you look at that OCS data request, it has been quantified, and it is in that.
Okay.
In the DRB spot. Okay. Now, slide 9 provides what was our preliminary estimates, or our estimates at the time of the change for excess deferred income tax and the amortization that was included. The 20,470,000 for the ARAM is the same as the 26 million on the prior slide. It's just one is a revenue requirement, the other is the amortization. So if you amortize the 20,470,000, because of the gross up for taxes, it actually impacts our revenue requirement by the 26,413. So that's just to let you know how come there's a slight difference, well, big difference. It's because one's the revenue requirement and the other is the amortization. The table on the left is our excess deferred income tax balances, and we have, since this filing, found that there is, the totals are all correct, but there is a movement between the protected and the non-protected. And I'll let Ryan explain this one.
Yeah, sorry, so, I mean, it's just, there's a lot of data to get through, and it's just continuing to look at the information, but there's a method by which that we have, quantified the protected versus non-protected items within power tax. And looking at that, we had basically a revision of that approach, and that shifted some of the numbers around a little bit in those first two categories on the property related. And we'll get that update to you.
You're saying since this?
Since this, yeah.
Oh,
Since-
okay.
yeah. It's something that has been evolving over the last couple of days.
Which direction does it shift in?
Well, I'm sure it goes
Not by design, but yes.
And you want to talk a little bit about the salvage?
Or cost of removal,
Okay.
yeah, so
Cost of removal.
there is a component that so cost of removal is not a protected item. Salvage is, and book depreciation is. And if, generally speaking, because those three are combined as a rate, our depreciation rates have elements of all three of those items. We can't particularly isolate the cost of removal from the other two, and therefore we've treated those as protected. So on the book depreciation side of the house, all three elements of book depreciation are treated as protected, so as not to violate the normalization requirements with the two out of the three components that are protected. So the three components are just your base level book depreciation, salvage, and cost of removal. The book depreciation and salvage are the two protected items, and the cost of removal is non-protected. The cost of removal would represent a regulatory asset as opposed to a regulatory liability from the standpoint of excess deferred income taxes. And it's quite a large balance, based on our a preliminary look at those items, but it's hard to isolate the number. So right now it's included in the protected bucket. Were we able to isolate that and properly classify it as non-protected, it would reduce the non-protected amount further.
So that's the change in the method. You've taken that one component out and moved.
There's two changes. One we
can't quantify, and it's just in terms of protected versus non-protected, and that was the first thing that we talked about, where there's a shift, and we'll actually submit revised numbers on that. On the other side is there's this cost removal element that we have a ballpark number for, but in practice and in our books and records, those numbers aren't isolated, and so we have in our power tax system we have one number effectively for book depreciation,
right, rather
than three line items that come into power tax and can be isolated and quantified differently. Were we able to do that? What we're saying is
that is what you're doing, though. That's the second change is
Right.
what you're talking about, is the cost of that removal. You're breaking it out of those components, and so it's shifting this.
Well, we haven't done that, and I'm not sure, we'll have to see to what ability we can do that. What I'm saying is, in practice, we don't do that.
Right.
But were we able to, it would further reduce the non-protected item.
And that is what you're doing, though.
No.
You're not doing that.
Right now, the cost of removal is up in the protected bucket. It would basically be, that 1.3 billion has a reg asset component in it.
Right.
Or an asset
A
component.
negative number to
Right.
it, essentially.
Yeah.
Which that negative number should move down to the non-protected,
I was just trying to
to make
clarify.
it smaller.
Yeah, so there's two corrections. One they found, which is just within the system that's smaller, but then they also have the removals, and we think it's going to be, our preliminary estimates are it could probably change that non-protected by 50%-ish.
And so that's one of the other reasons, as we've thought through how to actually amortize the property pieces, is keeping all the protected and non-protected together, because there's somewhat of our books and records aren't set up to do an exact track of those non-protected pieces, and so we're leery of giving back something when there's a component of it that we wouldn't, that's sitting up in the protected. So that's why we would rather leave the system as we've historically had it and keep all the components together. That's part of our proposal.
Yeah. Hey, this is Morris Brubeck here. I have a question on this. If you spend the $40,000 or whatever it is to make power tax so that it can distinguish properly, does that solve this problem?
No, because it's the books and records that are the issue there. We don't have our depreciation rates by all these components to feed it to power tax.
So what do you get if you modify power tax as discussed?
We would only be able to separate the components that we have quantified as non-protected, and then power tax would call it reverse South Georgia, but they would essentially set it up on a different amortization schedule based on the outcome of the proceeding. So that's essentially what would happen is they would take the amount, in this case, the non-protected piece, let's say the 259 million, they would be able to separate that component out and amortize it over the determined period.
And then we would have to do additional work in order to try and get the accounting records broken out so we could further refine that number.
For cost of removal?
Yes.
Yeah, so right now what I'm saying is, it would only be anything that we could classify as non-protected with certainty right now, because we can't do that breakout in power tax. The cost of removal would just be left in the protected bucket.
No, I have a
is the 259, and I understand that's subject to some adjustment, is that your best estimate currently of the unquestionable portion that is non-protected?
Yeah, subject to this update that we'll do, but yes.
All right. So then, if I understand correctly, there could be some non-protected amounts in what's called protected.
That's right.
Right.
But it's
so there would
actually an offset.
There would be no impediment to pulling back the 259 or a share of it over a shorter period of time than ARAM. And there would be no risk of IRS violations.
Yes.
Doing that.
Yeah.
Right?
I think I would agree with that, yes.
Okay. Thanks.
When are you gonna file that update? Do you know when it's time to come?
I mean, we could probably make
We just found out about it this morning, so.
Yeah.
As soon as we can.
Just a little time to get
that
through
in,
the data,
yeah.
but.
Yeah.
This is Donna. When you filed that update, OCS had several data requests on the ARAM going out for the protected and unprotected. Could you update the data responses that are impacted by the update as well?
So these are data request responses where we previously didn't have the level of detail that you were requesting. Is that right, Donna?
No, I had asked some data requests about the breakout between the protected and unprotected.
Oh, I see. You just want, I see, yeah.
For future years.
Yeah, and this isn't changing the ARAM. This is just a classification of the excess deferred.
But it's those data requests that she asked for the future years.
Oh yeah, we've only done the future years look one time. It's quite an effort.
It's day one. That's when it was done.
Yeah, I mean it's quite an effort to actually rerun the whole program to isolate the ARAM. And so we haven't, Donna, done any updates to the original estimates that we've done for the future years.
But the question is, when you do this correction, would you then correct data responses? Or there wouldn't be any change, is that what you're saying? I mean, you wouldn't.
Depends on the data
I
response too.
Yeah, I mean, I think the answer is that there wouldn't be any change. This is just with respect to the original quantification, so of the excess deferred income taxes. I don't know how to explain that better, but it's not a within system change. The calculation of unprotected and protected was done outside the system, if you will, in terms of trying to quantify that on a jurisdictional basis. And so it was that out of system calculation that we are making the updates through. So the amortization, Donna, I hope this is making sense, that's within the system and coming out of the system hasn't changed in terms of its categories of protected versus non-protected.
Okay. And again, I'll go back and look at my data request to see if I need to shoot some follow-up, or if maybe I can just ask for updates of specific ones once I go back through.
Good. Okay, are there any more questions before we go to the the questions we've already had submitted?
Yeah, just on slide 9 there on the table on the right, non-property related, I'm seeing a 0 in the column.
Yes.
And then I'm reading the footnote, so I have two questions. Given the footnote, what's the practical implication of amortizing 0 over 5 years?
Oh, we're not saying we're amortizing 0 over 5 years. What
So
we're saying is,
what's the relationship between the number in the table versus the footnote?
okay, what we're saying is, if you look at the table on the left, on slide 9,
Okay.
we've got $46 million of non-property related, of which, 23 million is Utah.
Okay.
We're proposing to start the 23 million amortization in the next rate case and amortize it over a 5-year period.
Okay.
Yeah, I think the keynote here might be that table shows what's included in this filing today.
Right.
And we're not doing any amortization of that non-property.
Oh,
in
okay,
this
so
filing. We're doing
get
that with,
Yeah.
we're proposing to do that with a rate case.
So, where's the guarantee for when the next rate case will be?
You don't have a guarantee, you just know we have a target.
Okay. Yeah.
Any rumors? I mean, it hasn't changed, I mean, we're still.
Yes, but that's my point. Well, maybe I should
2020
make my
or 2021
point with the
effective.
commission here. But my question is, when does the company? Well, I asked my question. Is the company guaranteeing they're going to file a rate case in 2020?
I can't guarantee we're gonna file a rate case, but the deferral continues until,
Yeah,
a rate case.
so we'll start in a rate case.
Balances on the left, are those non-grossed up for taxes or grossed up?
They're the non-gross stuff, those are the actual balances.
Okay, thanks.
And so maybe and then to tie into Artie's question a little bit, so the items that you're identifying for amortization now are being deferred for later benefit of customers, correct? Whereas in the case of the non-property, you're not really taking any, you're not doing any amortization at the moment, but it's still there to be amortized for the benefit of customers effective in the rate case.
Yes.
The other stuff is being amortized, but in essence, it's also being held aside as a deferral for the benefit of customers. Is that a correct characterization?
Part of it is.
Okay, what's the part that's not?
Well, we currently have the order on the 61 million, so
Right.
it's anything.
Oh, okay, fair, yeah,
Yes.
sure, yeah, on the 60, but the 61 million was really 35 versus 21, right?
Yes.
Okay.
It was the preliminary estimate of that.
Yeah.
Partial.
Sure, okay, yeah, exactly, and so.
Yes.
And I'm, right, and there's a portion of that that's also, there's a portion of the 35
Yes.
versus 21 that's also being deferred.
Yes.
And then,
But you are right in that anything over the 61, that's what we're proposing.
okay, thanks.
Okay, should we go on to the questions that we have had asked? So on slide 11, if we go to the first question, are any of the jurisdictions in which the company operates requiring that the non-protected property-related EDIT be amortized over a shorter period of ARAM than the ARAM amortization that is required for the protected property? If yes, which? If no, what is the status? Utah is actually the first state that is discussing this. So, no, there have not been any other states that have said to accelerate it, but none of the other states are as far along as what Utah is at this point. We have made, when we did the June 15th filing, there was filings made in 3 states, Utah, Wyoming, Idaho. None of those have moved it to testimony, and we have had no meetings with other parties on that at this point. And we don't have a set schedule.
But Idaho and Wyoming, you're subject to settlement?
We have settlement, we had a settlement on the preliminary in Idaho to start giving back a portion of it, and then the deferral from the preliminary estimate, and then as part of that, we had to file the full calculation on June 15th. And so that'll kick off phase 2, which is, will just be a new phase of the proceeding. In Wyoming, yes, there's a settlement with WYEC and the company that is still, that has been, we've updated the number essentially with the June 15th filing, but the settlement still stands, and that's just being processed
And so
slowly.
it is only with WYAC in Wyoming.
And in Oregon, I understand you're recommending a deferral of everything, and can you just update us on the status of where things are in Oregon?
And we have deferrals in all the states except
Yeah,
California.
we've agreed in all states to deferral. We've met informally with staff in Oregon and Washington. They both have said somewhat that let's just keep deferring it. When you get numbers later this summer, file them, and then they're going to decide on the procedure from that point forward.
Okay, thanks.
So it's right now in an informal phase.
And you made an April supplemental filing in Oregon, right? I think something like that. Have you done any other filings?
No. And like I said, we've met with staff, and they were, you know, because of other items, they wanted to wait off a little bit of time, so we're just.
Thanks.
So that should be the status in all the states. The second question on 11, we have already discussed when we took out of order. The next one, the company is proposing that the non-protected, non-property related EDIT of $22.6 million be amortized over 5 years. Take it over, you can read the question. The question actually comes down to the final issue, which is, are we proposing a carrying charge on that? We are not. And the reason is that reduction would have been those amounts would have been a reduction to rate base in the last rate case. So customers are already getting the benefit. If we were to move it and start amortizing, we would actually try to move it out of rate base, and there would be an offset the other direction. So we would start to increase the return, and then we would do the carrying charge. There would actually be 2 components. But right now, that is the reason for the, you know, that benefit is already being flowed through. The next question, the top one on page 12. question is about, Mr. McDougal's testimony is about the plant in service. And it was, we've already discussed it. Donna already raised the question. It was about why did we annualize the prior? And so I think we've already discussed that, haven't we, Donna?
Yeah, we have.
So, the next question, the middle one on page 12, the amount of property-related ARAM amortization will change annually. For example, responses indicate on a total company basis. We have given preliminary estimates. Ryan has already discussed it. We did that based upon the plan. It's a very complex calculation. Are we proposing to update it annually? Our proposal is, just like a rate case, let's set it based upon this level, and then we'll keep it till the next rate case. We are not proposing to try doing annual true-ups on the tax impacts, nor are we trying to recalculate numbers every year and look at each individual year saying what is the with and without taxes. The further you get out, the harder it is to maintain numbers and to say, what would it be with and without this tax in a future year? So we are proposing, not the company proposal, if you look at the exhibit 2, was just to keep the amount as set in this proceeding.
And then, and so when you file the rate case, you'll just, whatever the numbers are in the rate case, they'll be included, but you're not proposing that in the rate case, you'll go back and true up.
No, we are not proposing to try doing each individual year.
Okay.
And recalculate.
I have a question on that. If you were to set it at a, say, higher level based on the fact that you're anticipating, you know, this 59 million on a total company basis in 2019, and you set a higher level now up until, say, the next rate case, would that cause you to incur an IRS violation?
Yeah, I mean, it's on its face, it seems like it would, yeah.
So then you expect that this 26 number in Utah, or the 44, is kind of the lowest level, or it would, you not the lowest, but you would absolutely not go. It would not cause you to incur this normalization violation.
Right.
See, if we were to try looking at a future year, we'd really have to walk everything forward to that future year to avoid the normalizations. You'd have to walk forward all of your plant and everything else.
There has to be a consistency to the calculations. Sorry, go ahead.
Yeah, I have a question on this, because, you know, in the prior exhibits, you've broken out the 92 million between the portion related to the current taxes and the portion related to the ARAM amortization. If you were to track the ARAM or somehow defer the difference in the ARAM amortization from that 26.4 million you've included for each year, and again, just track or have a deferral associated with that ARAM, then that wouldn't violate any normalization rules, would it? And I'm asking because I don't think it would, but I want to make sure
I don't think
Brian has the
yeah.
same.
I mean,
okay.
On it, yeah. I wouldn't seem to cause a problem in my mind initially.
Okay.
Okay. Could you please elaborate, the next question, the bottom one on 12, could you please elaborate on lines 98 through 102 of Mr. McDougal's testimony regarding the AFUDC equity and tax schedule M adjustment and the impact the correction had on the December 31st, 2017 results of operations? Also, was a similar issue where a mistake made in the prior June 2017? The AFUDC equity Schedule M correction related to a FERC audit entry that corrected prior year balances. So last year we had a FERC audit. And as part of that FERC audit, we had a whole bunch of entries that we had to make on the books. The company, correctly removed the impact of the prior period balances in the adjustment 4.5. However, a component of the adjustment impacted the AFUDC, and the company should have included a Schedule M for that same amount that we included in the 4.5. As an oversight, we did not. And so it was just the December results, and it was just an oversight on that FERC audit adjustment.
Okay, thank you. Yeah, from the testimony, I wasn't completely clear.
Yeah, so it was just, yeah, it's just purely something that, as we did the adjustment for the FERC audit, we missed.
Okay.
And as we were going through on the tax items, right at first they said, we've just found this error, let's correct it. Okay? And next question, the top of page 13, let Nikki
Those are me.
go on to those ones.
So this is talking about our various ratios and scenarios and analysis. The first question about what is our cash from operations pre-working capital over debt ratio. We had attached the Moody's confidential ratings opinion of Pacificor from the 22nd of June, and that shows that our calculation by Moody's is 23%. And then the next question about if we actually begin flowing back the requirements of the rate reduction, but we defer the non-protected, how thick would the equity have to be to hit the 20%? So we haven't run that scenario. We've run a scenario which we'll be providing as part of the updates, where we've taken basically our proposal that we would give back 100% of the current, I think that's where we were at. I'm trying to remember the scenario. The scenario did 100% of the current. It's different from the proposal. We defer our ARAM, and then we amortize the non-protected over a 5-year period beginning January 1st, 2019. And in that calculation, we don't thicken the equity, but in that we actually do not hit the Moody's metrics. So you guys will see that when we file that confidential attachment. So when you start thinking through other scenarios on top of that, if we were to add, for example, the ARAM and start returning that January 1st, 2019, that would make the metrics even worse than what we'll show in that scenario. The thickening of the equity, it sort of goes into the next question, whether the company actually would be increasing their common equity percentage. High level, when I was kind of thinking through how thick would the equity have to be under the scenario, it's probably going to be 100 to 200 basis points thicker than our current allowed levels, which is about 51.6. So I would expect it to pop up to closer to 53.5%, but that's just kind of me trying to high level ballpark what it might look like. But then back to the next question about would we increase or thicken our equity on a short-term basis. And our position there is that, there is an amount that, of course, we recommended in a case, and that was ultimately approved for our equity percentage. And we try to target that level because that's what we're authorized to earn at. So to have a thicker equity percentage ends up, impacting the company's return on equity. Therefore, we generally wouldn't do that if there is a opportunity to have this set of numbers proceeding, whatever we call it, to have an offset for a thicker equity wherein the customers would pay that revenue at that thicker equity. Obviously, we'd be willing to thicken the equity in that type of situation. So that's the answer to that.
Okay, but there's nothing specifically precluding it. I just didn't know if there were any covenants or regulatory requirements in various jurisdictions that it be capped at a certain amount or anything.
We do have various covenants that limit how thick our equity can be. Some of that's been approved by the commission, and I think it can't go above 60 or 65%. It's somewhere in that range, obviously, because that would have a significant impact on how much customers would be paying us. I think it was one of the merger commitments.
Okay.
Yeah, and I want to say it's a 60%. It's either 60 or 65, because then we have another one in our mortgage that's the opposite, the 60 or the 65. I can't remember that.
Oh, okay.
Which one? Yeah. The specifics on them.
Now, if you, like, short-term increases as a temporary mitigation measure, would that get you through the concerns with the CFO to pre-WCD levels, or would it need to be a more long-term change? Or could you just do, like, a short-term mitigation measure to get you around those other matrices?
So we could thicken the equity, and like I said, we would request to have the revenue associated with that provided by customers, rather than the company thickening the equity and sacrificing its return because it's not able to earn on that, let's say 100 or 200 basis points difference.
And that would have to apply to all jurisdictions.
That would be ideal. It's a little tricky to hit a number when the states aren't all on the same page with that percentage.
Yeah, and I guess my question is kind of like how, over what time frame would you, if that were considered a reasonable mitigation measure, how long would that have to be in place? Like how long, like, do you understand what I'm saying? How long?
Yeah, so right now, when we file the other confidential attachment where we did this other scenario, the biggest pressures are happening in 19 and 20. So those would be the time periods where a thicker equity would likely be necessary if that's our only option, because we've refunded 100% or all of the tax dollars. I think, yeah, Joelle has the old confidential exhibit where we did multiple scenarios on that topic. And usually it was those 2 years that were the most challenging time period, 19 and 20.
Okay, thank you. And I assume this update will give us, various runs so we can get a better feel overall where it's currently at.
Yeah, so like I said, it has one more scenario where, and I can explain a little bit about what we did. We had, when we were here before, the confidential exhibit leveraged our business plan. We are in the throes of creating the next business plan, so I'm kind of in an awkward position of trying to update for other known changes, load across our entire service territory, changes in our capital investment. So we took what we know preliminarily from that version of the business plan and then layered on various other assumptions around, for example, the order we have from Utah to give back the $61 million, the agreement in Idaho, I think we get back like $6.2 million, Wyoming's agreement, and then nothing yet in the western states. So we layered all those known factors in and then made assumptions as to what would happen effective 1/1/2019, and our assumptions were we were allowed to defer the ARAM, so all the protected pieces. We would give back the non-protected over a 5-year period, and in that scenario, we still don't hit the metrics in the applicable time period in the 19 and 20 time period. So that's what you'll see. So then, like I said, from there, you can kind of say, all right, if we end up giving back more, let's say the ARAM has to go back right away, then those metrics will just become worse. And to your point, the way the company could do something would be to thicken the equity, and that's where we're hesitant to do that because we are not allowed to earn on that thicker equity percentage.
So Moody's has kind of indicated that you have to kind of sustain these levels.
Correct.
And obviously you guys have the backing of your parent company. How have you guys had any discussions? How do you interpret that? What does that mean for you guys as far as sustaining that? What is the, I guess, what's the real risk of the downgrade? Do you guys have any sense of that? Because, it's not just if this, then that. It's not, if we trigger this sub 20% CFO pre-working capital debt ratio, it's instantly going to be downgraded. What is that? What is sustained? Have you had any discussions with them? Do you have a sense of what that is from your experience, or?
Yeah, so from Moody's, as you can read in the report, I'm assuming that's what you read, there is the language in the one that they just issued that says, we expect that the company will fund and finance their capital expenditures consistent with the level that maintains their metric at 20%. So that's what they've said to us, is here's what we expect. While we have somewhat of that BHE, let's call it halo effect, or the BHI halo effect, that, you know, we are probably rated higher than they would otherwise rate a utility that didn't have that BHI halo. And it's important to us when I look forward for our next debt offering. So we just issued $600 million of debt last week at fairly favorable rates. If you look at what was happening in the market, we're going to probably be doing another $1 billion in the January, February time period, and it's then that I, you know, don't want to see a downgrade for actions that might happen where we start giving back more dollars. How much is that worth? It's hard to tell because it really depends on what's happening in the market at the time. You know, our gut would be it's going to be somewhere between 10 and 25 basis points on $1 billion. You know, spread over 30 years, that's the cost that it is ultimately to customers that would be embedded in our cost of capital. So it's all those types of factors that we're trying to consider to maintain our ratings. It's because we don't want that cost to go up for, you know, ourselves and ultimately the customers. But you're right, it's hard for me to say Moody's will absolutely give a downgrade the second it drops below the number, because they might give us the benefit of that BHI halo. And they might, they're seeing it there. If you guys saw that Moody's issued a negative, I think we attached that one version, you know, negative outlook across the entire industry, because they're seeing exactly this. They're seeing the impacts of tax reform negatively impacting the financial metrics of the utility industry. So that's what we're kind of up against, trying to hold on to not having that happen to us, especially in the light of issuing some more debt here in the near term.
Okay. Just a terminology clarification, Nikki. When you say we ran an analysis and we don't hit the Moody's metrics, you're saying we don't achieve the Moody's metrics?
They're below the 20%.
Below.
Correct, yeah.
Hi, this is Chris Walters. I just have a couple of follow-up questions, if you will, please. Number one, going back to the potential of a need for an increased common equity ratio for mitigation measures. I mean, there's other alternative methods, correct? I mean, you could increase, I guess, not that you would want to, but you could not pay out dividends, which would ultimately increase your common equity ratio, or you could slow down your CapEx program. Is there any other methods that are available that I know Moody's prescribes as quote-unquote self-help methods to get through? And then two, on the Moody's outlook for the industry, it's my understanding that was already what's driving that 12 to 18 month outlook for the industry was already taken really into consideration whenever they did the outlook changes on the 25 companies back in January. And correct me if I'm wrong, but I don't know that the rating agencies make ratings changes or actions on such a short-term perspective. It's more or less my understanding that they do more of a 3-year outlook as opposed to a 12 to 18 month, and that goes back to the previous question that the gentleman had regarding the sustained metrics. So if you can kind of touch on those, that'd be appreciated.
Yeah, so on the calculation of the metric itself, the ways to improve that, you pointed out the dividend. Yes, not paying dividends would thicken the equity, so that has the exact same impact. That would be how we would thicken the equity, is we would either not pay the dividend, and I believe we have like two $50 million dividends left this year, so $100 million that we currently would anticipate paying absent any other action we would have to take. If that didn't thicken the equity enough, then we would need to request a contribution from the parent company. So that would be an option. Those usually are coupled with, that changes your ratio of your debt. Doesn't necessarily mean I have to change how much debt that we issue. By virtue of doing the dividend, you achieve the thicker equity. The other more impactful side to the ratio is actually improving cash flow, which is the side where if we get more cash or pay out less cash, that has a much larger impact on a per $1 million basis on the metric than the equity and debt side. I think we've calculated if we have a $10 million improvement in cash flow, it improves the metric by 10 basis points, where the equity side, it takes $100 to $200 million to get that same 10 basis points improvement. So those would be the actions. In terms of slow rolling the capital, it absolutely is one of the things that we look at all the time. I'll say we do our business plan every year, and we are constantly looking at the capital spend, the need for projects. Can projects be pushed out without sacrificing reliability? Or are there any safety issues or other issues that have come up in the the company or in just out in the industry that we need to do a certain project? So that happens all the time, and we definitely look to do that to try to get ourselves to these metrics so that we're achieving them over a long-term basis. So that hopefully that helps kind of explain the metrics and how we look at it. In terms of Moody's themselves, yeah, they typically look at a 2 or 3 year time period for us, and when they say they want us to be at that 20% level, you could argue it's a 3-year average, and it's going to be more of a look back. They'll look back at the last couple of years and then factor in sort of a current year projection, and then want us to be at that 20%. And I think I had depicted that on the confidential exhibit when I was here before about here's what that 3-year average does. And in most scenarios, that third year still dropped below the 20%. Would we get a pass from that? I don't know. If we got there, I think that's what we would have to have those conversations with Moody's, and we're trying not to get there. I think that's the point, is we would rather be able to take actions at the company to not miss that 20% so that we don't have the risk of the downgrade than to have a number that doesn't hit their metrics and then force Moody's to do some sort of reaction. So that's how we're trying to balance it and play it with the rating, with Moody's in particular.
Understood. Thanks for your explanation.
Okay, anything else on that? The next question from the OCS, I believe this is the last one, is about OCS 5.17, where the company mentioned that we had done the 2018 planned additions and associated depreciation so that the impact of the change in bonus tax depreciation could be included in the filing. There was also a comment in there that stated that in order to avoid violating IRS normalization rules, all pieces must be included in the calculation. What that specifically is talking about is not that you have to do the 2018 planned additions, but if we do it, we cannot just in the filing add a difference in bonus tax depreciation without including all components, without including the plant and the depreciation and all of the components. So you cannot just put in one component of the change. So that's what we're referring to there, is we could not just try to isolate and say, here's the impact of bonus tax depreciation without adding in the plant, without adding in the different components of the plant, the depreciation, the accumulated depreciation.
Okay, yeah, I found the wording of the response a little confusing. So
yeah, that's what we're meaning to say, and looking at it once you question it, it's like, yeah, it could have been a little clearer, but all of us who wrote it knew what we meant to say, so.
No, I understand it now.
Okay.
Thank you.
Okay, then the next slide are some UIEC questions.
Yeah.
For that.
So I think I generally addressed this one when we were talking earlier, that we have one additional scenario that we'll be providing. We should be able to do it before the 27th because it's pretty much done. I think maybe the other thing that's come up is there's been questions about, provide the calculations and provide it in an Excel file with the formula intact. And I guess I just wanted to make sure everybody understands that these calculations are in our business plan model. It's not something that's a simple Excel spreadsheet where I can provide that with the formula. I think the calculation of the cash flow to working capital pre-debt, that's easy math. But the build-up to get there is our entire business, so there really isn't anything that we can provide that would give you the formulas. I can't remember who in particular asked for that, but it's just not, it's our UII business plan model that does all those calculations. And I guess I would be a little bit leery of, people, if I were to do a simple calc of here's the spreadsheet of people trying to change one aspect of the formula and say, oh, you just need to do this, and you solve it without knowing what doing that actually takes at the company and the other dependent factors of when that happens. So if cash improves, then debt actually does slightly go down because I've got more cash and I don't need to have as much debt. So it's those sort of interrelations that I'd be leery if we gave a simple spreadsheet with just the calculations of the metric. I don't think it would tell a good story for someone to play with it. So, like I said, I don't know who asked for it.
I believe that was me that asked for it, or I asked something similar to
Yeah.
that, and part of that was, maybe somebody asked a similar question later, but this was in the original filing that we did, because that was brought up.
Right.
Anyways, the confidential filing that you eventually did had the debt
Yeah.
for the 39 and 40 dockets in it that hadn't been decided yet.
Mm-hmm.
So anyways, just understand why.
Okay.
I guess I have a quick follow-up on that then. I mean, if we aren't allowed or aren't able to have an Excel sheet to where we can take a look at different scenarios, would the company be willing to provide the numbers at different scenarios so we could have a better understanding then? Because I think in UIEC's most recent set 10, those were objected to. So I guess I just really want to know how we're supposed to have an understanding of what the impact really is if we can't get an Excel sheet, and then if you're going to object to the question seeing the impacts at different scenarios.
So we had provided in that confidential exhibit a fairly extensive list of scenarios, and I don't know if it could end up being some sort of conversation where we talk through, okay, if we did X, like I said in the scenario that we're going to provide, where we made an assumption about how to defer ARAM. Well, what does it mean if we don't defer ARAM? Well, it means we have more cash going out, the metrics are going to decline. So I think that might be more useful, because running each scenario takes probably about 5 days, and usually we run into trouble when we're going through it. Okay, we have to do this. All right, that wasn't quite right. So maybe there's some sort of engagement or conversation that we could have that might be more useful than people just asking us to run version after version on something that maybe we already have enough guidance of what the metrics look like on the versions that we've provided before. I'm willing to do that if that would be helpful.
So how would we arrange that?
It's a good question. Maybe it's something.
I
with,
arrange it.
Okay.
Yeah.
Yeah, we could just be meeting like this, dedicated just to that topic.
Yeah, that might be, and if we could have, I don't know if the guy who runs our model could have a version of it. That also might take a while if we sit there and try to play with it, but maybe there's something that we can give sort of our gut check of what it would mean to the numbers. And if it's a real, this is absolutely where we're going, maybe we pick 1 or 2 more versions to run instead of 5 or 10.
I would just say to that though, one of the things was, when I initially asked for it, you guys said that we haven't ran that analysis, we can't provide it.
Yeah, we haven't. Right.
Well, then it was provided as a confidential, exhibit like the day before the hearing, and so there wasn't anything I could do with it. And so, I mean, I don't know if there's like a base scenario that you could give us those background numbers that are computing these, so that we could just say, we recognize that there are, changes that flow through the entire system, when we change this number, but to give us some sense of what is the impact of this scenario and this scenario. I don't think, is that out of the question, or, what's the most likely scenario? Give us the background data for that, and then, let us work with that recognizing that there's going to be some change. Anytime we change that number, there's a flow through that happens.
So I think the question of what's the most likely scenario, I have 6 states that we're dealing with, so that's where the complication comes in, is we are and have made assumptions of what we would like to see as a scenario that would have a base set of data, and maybe this one that I'm talking about would be, I don't know if I would say it's the most likely, but it's not far off from what a proposal could be. If maybe we start with that one. I don't know, I think that's the trick, is like, it's hard to say what is the most likely scenario.
Because you've been trying to set sort of the parameters.
Yeah, which is what the other exhibit did, was the parameters of here's, if we give back 100% and we give back the non-protected in a lump sum. So remember, that was here's almost a worst case scenario where it all goes back and that's the resulting metrics. Then we kind of peeled back the layers from there. Which one of those would you want to be as the basis for what you'd look at?
Well, I mean,
that's the hard.
Yeah, I get it. Anyways, I won't beat a dead horse, but I still think that it should be provided. Maybe the other color feels the same way, but.
Well, following up a little bit on that, this is Morris for UIEC. We had asked on behalf of UIEC some specific scenario runs, laying out what the metrics would be under different combinations of things, and I think the response was an objection. Do I hear now that there might be some willingness to provide those?
Well, I think we did, in terms of the confidential exhibit, do a handful of different runs when we were here back in April, and then I've got one more that we've done. So if those are the requests, I think it's when we get to, all right, now let's tweak this one or tweak that one, is there instead the gut check of, if I do that, let's look at this one as the base, here's what would happen, because I can talk through the dynamics of it, which would result in the metrics of X. And maybe I care about the metrics and perhaps others don't, but that's kind of what I'm looking to in those calculations, is what does it mean to the metrics, and hence would it result or possibly result in a downgrade. If there's some other reason that you guys want those, then.
Well, just to highlight an example that actually happened from the original hearing was you had the debt from the 39 and the 40 projects in there, which obviously weighted the debt portion higher than if we'd ran an assumption without the debt in there.
Without the projects in there.
Without the projects in there, right? And so that was still being, litigated and handled. Right. So, I mean, we didn't get a chance, we didn't get an opportunity to see what does that look like, because it happened, we got it and there was the hearing and there wasn't the background data to run our own assumptions on that to say, what does this really look like? And so I think that's what, at least I'm saying, is, without it, we're beholden to 5-day runs, and with the turnaround and the data requests, by the time we actually get it, and we don't have any, oh, hey, well, I actually meant this, or, so. Anyways, I'm just trying to make the case of that's why at least me would like to see that data, so that we're not so beholden to the schedule and the assumptions that the company is putting into it, and not, I mean, you're doing a great job and everything, but that's a perfect example of the projects hadn't even been approved yet and the debt was included in the original ratios.
Sure. And so I think that's then, to me, feels like other parties managing the business as to how they think the business is going to run and how we're going to invest in capital in the future. So that's why I think it gets a little bit tricky, and not understanding my debt maturity as well. So the debt isn't necessarily driven by the capital, it's also driven by the maturities and how much cash flow we have.
Well, I wasn't telling you we're not to do it or not, but
we're trying to formulate a position to make a recommendation to the commission. And without data, we can't. And that's what we're trying to find out, is how we can get data or information. Now, I'm perfectly willing. You say you have one more scenario coming out.
Yep.
I think it would be a good idea for Jana to arrange a conference. Not a technical conference. This is a discussion among the parties without the commission. so that we might be able to ask questions
Exactly,
about
yeah.
scenarios and have you say, well, that scenario is going to wind up between these two that I've already given you, type of thing, so that we can.
And that's what I
Let's
think
get some more.
I would find that more useful. That way we're kind of engaging and understanding, so that, you know, if someone is just looking at a spreadsheet and trying to make one change, they won't necessarily know all the dynamics and what that truly means. That would be my preference, and like I said, we're happy to do that to figure out, you know, how to get through this.
When
and people
do you
understand.
think the other scenario would be ready?
It's pretty much done, so it could be any time. I think we were trying to push to make sure we didn't need to make any changes to it to have it out by the end of next week, which is the 27th. But I can talk to my controller back there to make sure it's set. I think we're probably pretty good though with it. So I don't know what that means in terms of timing and when we would want to.
July 24th is wide open for this.
I would do it as soon as possible.
Yeah, no, I'll get on that, we'll get some times out to people. But when do you think, because it's helpful probably, we probably don't want to have it until after that, so we can get it set up, but probably want to get it set for after you provide that last scenario.
Yes.
So, yeah, stay tuned.
I have just a very fast question, because I noticed the question references a confidential RMP1 from the June 15th filing, and I have a confidential exhibit with various scenarios from an April filing. Am I looking at the right one, or was an additional updated version filed with the June filing?
Yeah, I think I think we meant the April.
Yes.
And it wasn't a filing, it was part of, well.
It was an exhibit.
It was an exhibit in the hearing.
Yes.
Oh, okay. I just wanted to make sure there wasn't something else filed later in June that I didn't have.
No.
Okay. Thank you.
This is Morris. Before we leave this subject entirely, in UIEC data request 10.1, we asked for the Moody's metrics under several different give-back or flow-back scenarios, and we got an objection to it. I just wonder if, in light of our discussion today, you all would be willing to revisit that question in your response. We weren't asking for spreadsheets or models. We were asking for the Moody's metrics under different kinds of assumptions.
And I would have to go back and look at that one and compare it to what was provided then as that initial confidential exhibit. And could we come to a agreement that what was already calced and provided is meeting the needs? And if there's anything else, we can talk through what it would mean in reference point to a particular scenario we already ran.
Except you've updated your numbers since then. Those April ones were provided based on was it September 30th or June 30th, and now you're on the December 31st numbers. So are they the same? Are they different? We just don't know.
And they were also based on giving us 72 million, or that 72 million was was all that was.
So all those calculations were a total company basis, and the total company give back hasn't significantly changed from anything that we've run. So Utah in particular didn't necessarily change it. The new scenario that we did, then we started grabbing each individual state's particular orders, but then we ultimately got to a point where we were giving back that total company number in the 2016 time period. So it shouldn't significantly change the metrics and the calcs. And so we can talk through kind of all of those pieces as well.
And could you relook at R10 and see if it's still objectionable?
Well, it's part of the conversation, I think, to see which elements, I mean, as Nikki talks through the different, from those scenarios, okay, this is what we see from based on what we've done and how that direction could go, and then trying to narrow it down so we're not doing 3 weeks worth of different runs on.
Yeah, because I think
for incremental benefit.
Because I think all of these give that big picture, and like I said, we can from there say, all right, if you were to do that, what might it look like? And I think the team, we would have a pretty good gut instinct as to what that's going to mean to the numbers after having done, a handful of these items.
So for that call, she would probably look at those and flag based on what has been done, the directional impacts. I understood that right.
Yep. That's what I would hope we could get out of that conversation.
I have one more question. Steve, going back to slide 11, I'm not sure I followed the answer that you gave on the third question there about the carrying charge. Could you go back over that again?
The non-protected property, that ADIT, or the reduction in rate base, would have been included in the last rate case.
If the tax reform had taken place before the rate case, is that what you mean?
No, even without it, it was in ADIT in the last rate case, now it's gonna be in the excess deferred income taxes on property.
Just a request.
So it's gonna be in a reg liability now instead of ADIT, but it's still the same dollars. So if you put the EDIT reduction in, you should raise ADIT, and the two are going to offset.
And then what about the carrying charge? I'm not sure I'm following where you said no carrying charge, or at least I thought that's what you said.
This was the non-protected non-property.
Yeah, because on the non-protected non-property, since that was included in the rate case, customers are already getting the benefit because of the reduced rate base in the last rate case. So customers are already getting the benefit of that. So if so what we're proposing is, we're not proposing to take away the benefit customers are already getting, because they're already getting that benefit built into rates.
Yeah, in other words, I mean, all ADIT is a credit against rate base, right? So we're, as customers, we're getting a carrying charge on it now, in a sense, since it's
Right, we're not paying it because it was a reduction or a deduction to rate.
Right.
Okay, thanks.
Okay.
I just have a high level question. I know we're probably getting short on time, but in the prior proceeding, the commission approved targeting 80% of a preliminary number to be the credit to customers, the $61 million. And so now the company's gone and run the numbers at the end of year, end of 2017 results of operations. And so the numbers come out lower than the preliminary number. And I was wondering if you might be able to give some insight, into what drove that lesser amount.
I think there's a variety of things. One is just better information. Because when we did the original one, we did just a quick change in the tax rate. And an example is when you change just the tax rate, there is already some ARAM that's built into the number. So we had restated the deferred income tax using just a straight 21/35. Well, there's some of those that are already flowbacks that should not have been in there. So the preliminary one that we gave was just a high-level estimate, whereas the number we gave now is a detailed, going through all the analysis. So that's the main thing that's changed, is just isolating all the components and making sure we updated everything, not just one subset.
I mean, so I guess maybe is it fair to say, looked at another way, taking the excess ADIT, putting that aside, because that was always going to be addressed later.
Right.
The 61 million that the commission approved has actually turned out to be about 94% of what the non-excess ADIT revenue requirement impact was.
Yes.
Fair enough.
Okay. And we always knew that was part of the reason why we wanted a percentage. We knew that this was, in order to get it out in the time frame, we knew it was a high-level estimate. We didn't. So.
Okay. I just wanted to circle back on that. I mean, we kind of.
Yes.
Okay, are there any other questions? If not, we're adjourned then. Thank you very much. Appreciate the company's presentation. Thanks for coming today.
Thank you.